Welcome to our podcast, Broker Banter Denver, where we are breaking down barriers to home ownership. I'm your host, Kim Davis, the real estate expert.
And I'm Patrick Williams, the mortgage guy. We're here to inform and educate about the home buying and financing process.
And on today's podcast, we are going to talk about the news that we've been waiting for. The Fed just came out with an update, and we're also going to talk about history of home prices here in the United States and what that means for you, the consumer.
How about those Buffs?
How about those Buffs?
How about those
They
Colorado
won.
Buffaloes? I would like to just make sure you're watching on YouTube so you can see
My
Kim's
poor husband.
beautiful University of Colorado
My
sweatshirt.
poor husband is probably so sad right now that his wife is wearing this. Let's be honest. Do I really have a stake in either CSU or CU? I really don't care. My husband went to CSU. He's a CSU alumni.
Yeah.
Love him, so I've become a fan through marriage, but I am a graduate of Metro State Roadrunners, which, I don't know if they're big.
Go Roadrunners. All I know is that I think everybody is happy that the Buffs won because nobody wanted to see me in a medium CSU shirt.
Actually, I'm sad because I think it would be so funny to see Patrick in a medium-sized shirt. If you've never watched, you're not like a big, you're big, like as in,
like barrel-chested. I'm not a small guy. No, I would. No. A medium shirt would be quite tight on me.
Yes,
I'm more of like an extra large.
Yes. Yeah. More of an extra large kind of guy.
Yeah.
Kind of like Jason Kelsey. Did you see him on Monday Night Football? His first broadcast. He had forgotten his bag in the truck when he went to get on the plane. So he had to go to Lululemon and buy a shirt, I guess an outfit. And so, which I thought, one, cool. It looked good on him. But two, he said he was a double XL.
Well, he's a lineman.
And but he had lost weight. So he said it fit in his tummy, but not in the chest area.
I was not a lineman. I was like a D end when I played. So,
a what?
Defensive end.
Oh, defensive end.
Yeah. But, Lululemon, I don't have any Lululemon shirts.
He has so many Lululemon
I have a pair of shorts and a pair of pants that the pants I travel in. Like when I get on the plane, that's what I wear. They're so comfortable and perfect. But I don't have any shirts, or I just wear like old t-shirts to the gym.
Oh, well, congratulations to CU Buffs.
Go Buffs. Go Buffs.
Go Buffs.
Okay, well, so are we going to talk about the Fed? I have champagne.
Oh!
Yes, or Prosecco. Today is the day that we have been waiting for.
Right.
For a good year.
We started talking about this in January.
Right. So we were talking about this in January. Last time this year, everybody was talking about how we were going to have 6 cuts this year. Here we are, middle of September, and we have our first cut.
Okay, if you're
scared.
watching
If you're watching, she's scared. She's flinching.
Okay, pop it. Yeah.
Here. Woo! Yeah! Woo! Let me hear some for you.
Yay! I just looked at it.
The Fed actually came out when we talked about it last week. There was about a 17% chance of a 50 basis point cut. And that's what they did. We have...
let's repeat that again.
Yes, 50 basis points or half a percentage point.
Right, which we had thought coming up to this date that may be a quarter.
We would see a quarter. I mean, I think everybody was pretty certain that we would see a quarter.
Right.
This time last week, it was a very small chance of a 50% basis cut. So here we are today. Cheers.
Okay.
We made it.
You need to come this direction so we can catch it in the...
Oh. There we go. So, yes, we're very excited.
Oh, cheers.
Very good.
Yeah.
Delicious. And, this is just, we've been waiting. The housing market has been depressed. Interest rates, really, it's probably one of the biggest factors, that when you talk about the market and what's going on and where interest rates are, it is kind of, it just drives housing so much.
It does.
Really, housing has been in a recession for a couple of years.
Right. And I think we're just seeing it. Well, it has been. There's definitely been a slowdown in the Denver market for the last couple of years, but it did not affect me as it did a lot of realtors last year.
Yeah.
It has affected me this year quite significantly.
Yeah.
And I'm holding on to more listings than I have in years. And, and having a conversation with a client just this morning, talking to them about, the Fed rate, and actually how I knew about the cut so quickly is he texted me. I was like, the announcement's coming out at noon. But I was, of course, coming over here, getting ready.
I was just so excited. I'm like, 50 basis points.
He texted me, they cut it by 0.5. And then I called Patrick immediately. And then we decided to wait so that you could share our enjoyment here on the podcast.
I mean, this has been a day that we've been waiting for close to a year. And really, I mean, what started in
January.
July of 2022 was when they started, their first increase was 75 basis points in 2022.
And so what does this mean? Let's just tell the consumer what this really means, and what we've also heard them say today also. There was more to it just than the initial 0.5.
Yeah, so there's usually three reactions the market has. Is the initial reaction, which was very favorable. I don't know that people actually thought there would be a 0.5 point cut. So I think everybody was pretty shocked by that. And then there is the reaction to his press conference, which is kind of I believe it might still be going on as we're recording now. I was watching it just as we got started. But, and then tomorrow we'll have another reaction. So far, nothing significant, no large movements. The 10-year is it's better by about 0.07 or 7 basis points. Mortgage-backed securities are down 16 basis points. So no significant movements. I think what people don't understand is that the Fed and their rate is kind of backwards looking, right? Like, so they're looking at data from jobs, from all that's been reported last month or the month before, the previous quarter.
Correct. So they're now just saying it's the same with housing prices, right? Like and appraisals and things. It's backwards, right? Because you are always waiting for the result of the past.
Correct.
So it doesn't mean that that's happening now, and they may be seeing some slowdown.
Exactly. And so the difference is that mortgage rates are forward-looking. Right? Because we want to try to anticipate what the market's doing, making sure that the rates that we're giving are going to be favorable on the secondary market, is mortgage-backed securities and all of that. And basically what we kind of go off of is the 10-year treasury. And that is definitely forward-looking. And to be honest, I think these cuts are already baked into the rates that we're at today.
Which you have been saying that for a couple of weeks.
Yeah.
But that being said, they probably have only baked in a quarter, because that's what they probably thought. And hopefully we'll start to see interest rates drop on mortgages. But it may take a few days.
We're seeing it. We've already seen it over the last week.
Correct.
Like September has been amazing for mortgage-backed securities.
Yes.
We have come down almost a full percentage point. So it's been great. I do think we'll continue to see rates get better as the year goes on. The Fed talked about 2 more cuts this year. So that could possibly be another 0.5 point cut. They indicated they feel like they're a little bit behind. I think jobs,
that's good.
They revised jobs, all these different things. So they feel like they're having to play catch up. And so it's possible that come November, I think it's the first week of November is the next meeting, we see another 0.5 point cut.
Correct.
And then maybe another one in December of a quarter. So we could see 1.25 in cuts before the end of the year.
Wow.
Yeah.
I mean, we were just hoping to get into the 5s. I mean, which cheers. I think, cheers.
Woo!
Cheers for all the buyers and sellers out there. Because this helps both buyers and sellers. It helps buyers jump into the market and helps sellers sell who want to sell and move on.
It's good for everyone.
Yes.
I mean, housing, let's just talk about what housing does.
Yes.
Okay? Housing is the biggest driver of the economy. When you have a healthy housing market and more household formations, it means more consumer spending, because what happens when you go buy a house? Anybody that knows and has done it before, you need stuff. Like, you just need stuff. You got to go get bathroom stuff. You got to go get different silverware organizers.
Blinds,
you got to get curtains.
Curtains,
Maybe you're putting in new carpet. You want to redo the kitchen.
Right.
It is a market driver.
Well, and not only that, but let's say that, for instance, someone has lived in a house and they sell it and they're downsizing. Well, now they have equity, right? All this equity, and they bought probably a new house, but they also have extra money to spend. They're going to go on vacations. They're going to go
maybe
eat
buy
out.
A car.
They're going to, maybe buy a car. So it affects all parts of consumer.
And I think it's the biggest driver of the economy.
What
I really
am I trying
do.
to say? Consumerism?
Consumer spending.
Spending. That's it. Consumer spending.
Yes. So it is a big driver. It's great to see that we
Sweatshirts.
finally
Itchy.
higher for longer is over.
Right.
You know, and nice sweatshirt, by the way.
Yeah. I took a second to process. You were in the
It
middle
did. It
talking.
did.
Sorry.
Yeah.
I was just kidding. It's not itchy.
So good news today.
Great news.
It's a day that we can celebrate because the housing market has been depressed during this high interest rate period.
Right.
We felt it.
Our market is seeing it, but
Yeah.
as we always say, and I'm sorry if we continue to just
Beat the dead horse.
Yes, that's what
or
we're
the
doing.
drum.
Absolutely, that's
Yeah.
what we're doing. We just, I mean, yes. Are we in the industry? Are we super? What's the word? Passionate about this industry? We are, but we also believe in the American dream. We believe that you, as a homeowner, have the right. If you want to own a home, can own a home, and we know that in Denver, what do I want to say? That finish line or that line has gotten moved a little bit. So here is an opportunity to get into this market and get in before prices start to raise, because I think you're going to see housing prices start to come.
The time is now. Really, the time was yesterday.
Yeah. Time was, 2019.
Right.
But,
but here we are today. And if
machine.
you missed out on that opportunity, don't miss out on this opportunity.
Correct.
Because I think we've talked about inventory and how high it is in Denver. And while we say how high, it's still a very balanced market. We just haven't seen this kind of inventory for years.
Yes.
So in the Denver market,
let's be honest, in 2019, when we bought our houses, I remember it was a little bit of a lull. Is for buyers, right? Or for sellers. Like, buyers were still in the market, but people were starting to get scared, and we only had about it might have been 6,000. I'd have to look, but it might have been 6,000 homes on the market. We have an additional 4,000 to 5,000 more homes on the market
10,
now.
possibly 11,000 when we start getting September's numbers.
Yes.
I don't think it's going to last. I think as rates come down, and even though market rates, mortgage rates are not necessarily driven by the Fed fund rates, what happens is people watch the news. Right. And everybody is going to hear the Fed is cutting by 0.5 point.
Yes.
And what's going to happen? People are going to start coming back and say, okay, now's the time.
Right.
We've been waiting. We've been holding off.
Right.
And if you are late to that game, I think you're going to miss the opportunity. We may, by March, be back into a position where we have a ton of buyers activity, limited listings, people are competing, multiple offers again. It could get back there very quickly.
Right.
And so if you want to capitalize, now's the time.
Yes, now's the time.
Yeah.
So don't wait. Beating the dead horse.
Yeah, beating the dead horse. Don't wait. Now's the time, especially if you have been kind of thinking that you wanted to get into the market.
Right.
The wait's over, and that's why we're celebrating.
It is. It is. We are excited to finally see,
Yeah, and it's
the Fed do something.
So they said two more cuts this year on top of the one that they just did today, and then 4 in 2025. So about 1 a quarter to bring that Fed fund rate back down, which is going to help everybody.
I mean, if I'm being honest, I think I'm going to try to get my kids into this market
now's the time,
right? Before, before they're not able to maybe own a house here in the Denver metro area. So I just don't know how much more we can just emphasize to you as a buyer that, hey, and then for the sellers who've been sitting out there, who've been sitting on their house for a month, 2 months, we should get more buyers and it should get better. So yay.
Yep.
Yay.
We made it. Congratulations.
Looks like we made it. I think I sang that last week too, didn't I? Did I just?
Yeah. So let's
excuse my singing voice.
Yeah, I think we all
deserve
an apology for that. So let's talk about home values.
Okay.
What do you think?
Let's talk about home values.
Okay. So I saw this article on Fortune, and basically it goes. There are 3 things that are certain in life: death, taxes, and ever rising home prices.
Yes.
So
very true.
Which is interesting because a lot of the hesitation, I think, of people wanting to get into the market is they're waiting for prices to come down.
Yes.
So this
Or
article,
the housing bubble, as people say, correct?
correct, to pop.
To pop.
Yes. And so this article basically states that's not going to happen. I'm sad to say. Right?
Well, we're not really sad to say because we are homeowners.
Well,
we don't want there to be a bubble.
So
but
yes,
we
as a
want-
homeowner, but
yes.
if you are not a homeowner
Correct.
and you're wanting to get into the market,
Correct.
I'm sure that you are hoping that prices are going to come
Right.
down because that's going to help
Right.
affordability.
And let's just be honest, right? The prices of housing has gone up faster than the prices of wages and the prices, and that's what makes home ownership such a stretch anymore for, the average home or average person, right? Because our wages haven't kept up with
They haven't kept up
Yeah.
with home prices. And housing inflation, I think, is the biggest piece of that inflation
Right.
number. Rents, I think, have started to come down, but housing prices have not. And with interest rates as high as they are, even though they are coming down,
Right.
thank goodness, housing is still very expensive.
Right.
And here's what I know. I've bought 2 homes in my life. I don't move a lot. We pretty much seem to stay in a house for about 10 years, and then we move. Both of those times that I bought felt like a stretch.
Yes.
Right?
I would agree.
Okay.
I would 100. So same with us. We've bought 2 homes.
Mm-hmm.
I don't know why we stretched when we first bought. So we had a little bit bigger of a house than we
Yeah.
needed. We had 2 children. Started looking for, another house and stretched again.
Stretch again.
Yeah.
And it's always going to feel like a stretch. But
Absolutely.
here's what I know. I'm 5 years down the road from when I bought that house.
Yes.
I am so thankful that I
Yes.
have the mortgage payment that I currently do, because if I were trying to get into the market today, it would be much higher, right?
Right.
And so even though that 5 years ago, that stretch felt big,
Right.
you grow into that payment. And the beauty is, whether you're looking at a 7-year fixed loan or a 30-year fixed loan,
Right.
that payment, your principal and interest payment never goes up. Unlike rents, which anytime you renew your lease or, you're going to end up paying more.
Correct.
There's
They
very
usually up it.
few
Correct.
landlords, and that's why people move a lot, because then, I'm not going to pay, $200 or $300 a month more.
Right. Because I was paying $1,500. Now you want $1,800.
Right. So I'll see if I can find another
Right.
place for $1,500.
Correct.
But so you don't have to worry about that as a homeowner.
You do have to worry. I mean, your payment does change, but it's not
Principal
due.
and interest. That was
Right.
very specific.
Right.
You're
Yes.
correct, though. Taxes
Yes.
and insurance.
Taxes and insurance
If you want to
change.
establish an escrow account, will go up. That is the one piece of the payment
Right.
that will vary.
But the difference is you own that piece of property and you also own that equity, right? Or earn that equity.
Yeah, we
and
talked
you have
about that,
right.
when we looked at
Right.
how the cost of waiting.
Right. And
Right?
so if you haven't seen that, that was 2 weeks ago. You should look at
Encourage you to
Broker
look at that.
Banter Denver, cost of waiting.
Yeah.
Yeah.
Yeah, that was
I think we named it
Marry the house.
Date the Rate.
That's right. That's right. So what just looking at this article,
Yes.
I was curious, and I did a little bit of research.
Mm-hmm.
The Federal Reserve Bank actually has a lot of great charts and graphs and information that you can go back and look at things.
So if you're someone who likes charts, check out the podcast.
I mean, who doesn't like charts? I mean, pie, graph, line, bar.
I like pie. I like bars. Anyways,
Graphs or actual pies.
I'm talking about actual pies.
Oh, I know you are. Okay.
Yeah.
So I was being a little sarcastic about the graphs. But I do think visuals really help.
Absolutely.
And so I found one about the median price of houses in the United States, basically since 1960.
Yes.
Okay. And when we'll put this graph up on the screen so you can take a look at
And
that.
so median house prices in the United States as a whole.
Yes,
Correct.
The entire United States, you can actually find states in here as well.
Right.
So we could always look at that and go specific down to Colorado. But I thought it was a better, to look at the big picture. Yeah,
yes.
and not dial it down per market and things like that. So looking at this graph, and to support the article that Fortune put out about home prices just going up.
Right.
I don't see but one, maybe 2 times since 1960 that I can see the actual graph go down. And when I say go down,
You mean significantly?
significantly in a short period of
because
time.
there are, I mean, it's definitely, it's not a straight line. It definitely,
not.
And I would say that we are probably in one of those not down markets, but down, like prices of homes have kind of plateaued. I mean, and even come down.
Yeah.
Like 10% down is still down, but is it going to go 50% down or 25%? No, that's what, we're kind of in a plateau, but you could say that currently, because of maybe the inflated prices of COVID and during that time, and that this is
they were maybe artificially elevated, and there was a correction that needed to happen.
So I would say we're in the middle of that correction, but that correction is not going to go back down to 2019 prices.
It's not.
It's going to go down plateau for a year maybe, and I think we're going to see, as we just said, with the interest rates going down possibly here in the future, in the very, very near future, that
I mean, I wouldn't even say possibly with interest rates coming down.
Yes, with interest rates coming down,
we've already seen it.
We are going to see housing prices start to raise again. So maybe we're in one of those slight lowering,
which
median home prices,
right? But they're not going to continue to come down. They're not probably going to come down much further than they already have.
So so we see a big one in like 2009,
which was the
bottom.
Great Recession, one of the biggest housing bubbles in history. I'm looking at the peak, which shows Q1 of 2007. The median house price was $257,400. At the very bottom,
which this shows Q1 in 2009 was about 208,000, just barely above 208,000 was the median. So let's just say that again, 245 to 208. And so here in Colorado, just because I was in the business at that time, our bottom hit a little bit.
I do feel like Colorado's a little ways ahead of the curve.
Yeah, our bottom was 2008. And then we hit over those prices in like 2010 or 11.
Yeah. No, I think it was 10. But I do think that we've had the painful part for people who are trying to get into the market. The run up that we've seen over the most recent 5 years has been really steep.
Yeah, I'm going to correct myself. Our peak was 2008 here, and our bottom was 2010. Okay. So we are behind the United States, right? Because the United States here, their peak, like as a whole in general, their peak was Q1 of 2007. We were 2008, so it didn't hit us, right? So even the bottom didn't hit us until after the average.
And the bottom is not as far down. Typically, our market seems to be more stable in Denver, and the Front Range of Colorado as a whole. The lows don't go down quite as low, and maybe the highs don't go crazy like some of the cities that we saw during the pandemic, like Boise and Austin that just went Phoenix, through the roof.
Yes.
But now, when you have those volatile markets like that, it's almost like investing in stocks that are super hot, but then when they fall really hard because they're overvalued.
Yes.
So I would say that's even more of a reason to buy in Denver. Yes. Because it is a much more stable market.
And I think we touched on that too, that investors were saying, hey, Denver is still a great market to buy in. So if you have investors buying in the Denver metro area, that means you as a homeowner is a great opportunity to buy, because investors are usually, pretty conservative. They're not going to buy in a city that they don't think is continually growing.
Exactly.
So when's the next low?
Well, so this most recent cycle, what I'm seeing was a high in the fourth quarter of 2022, which I felt things stop June of 2022 was when, and that's when the Fed started raising rates.
Yes.
So, it doesn't happen immediately, right? Like home prices were still going up. There was still a lot of market activity. So the average or median, home price was $442,600. And that was in Q4 of 2022.
Okay, but let's just talk about what happened here. So prices were from 2000, well, we'll say 2009 at the low here on this chart. And it was gradually going up, couple dips here and there, nothing like crazy or anything like that. But then it continually goes up. And then we hit 2019, right? Or actually the quarter of 2020. So what is happening there? And remember, our data is always a little bit late.
Yeah,
right?
we're backward looking.
We're backward looking. And so including this. So in the quarter 2 of 2020, let's remember COVID hit March of 2020, right?
Yep.
And so you can see housing prices quarter 2 of 2020 was $317,000.
Correct.
And all of a sudden quarter 4 of 2021, so we're talking about a year and a half later, the median
414.
price 414
Yeah.
goes up $100,000.
Just like that. And there was,
and
I think there's a lot, like obviously COVID was just an anomaly.
Yes.
There's every economic indicator or anything that you want to try to follow, everybody says you have to just throw that period out.
Right.
Because it was just, there was too much going on and nobody acted normally.
But I mean, the housing market, right? That's not like, are we going to see that huge of a spike?
No.
But if you look at this graph, right, it's pretty gradual.
Yeah.
Right. Until you get to that point, and it is
and then it took off. But
took off.
There are other periods, and just so you know, looking at the graph, the gray
is
area,
the down.
It's a
Yeah.
recession.
Yes.
That's when there was a recession. So we had, the dot-com bust of the early 2000s, the Great
Yes.
Recession of, 2008, 2009, and then in the 80s, prior to Reagan and all of that, right? So it does show that. But even during those periods, while maybe housing kind of dropped gradually.
Well, let's remember what happened in quarter 2 of 2001. I mean, that's right around 9/11.
Yeah, there was a recession that happened. Actually, we just remembered that.
Yeah. The remembrance
20
of 9.
yeah.
Yep.
4 years, I think.
24
now.
years. Yeah.
23. So 2001.
2001.
Yeah.
Yeah.
But there are a lot of factors that go into it. All of this really to say though, right? Are there quarters where from quarter 2 to quarter 4 there was a drop? Sure. But then is that made back up in the next 2 quarters?
Yes.
Yes, right?
Absolutely.
And so when you look at the chart and you watch what housing prices do,
Yes.
they go up.
And that's what I always tell people, like, hey, if you have to sell, then sell. But if you can hold on to it and not take a loss on a house, you only need to hold on to it for maybe 2 years, maybe only a year, maybe only a few months. But the likelihood of housing going up and you not having to take a loss on that house is very high. And I had that conversation all the time in 2008.
Yeah, and I mean, when you are talking to somebody and they're
Yeah.
considering buying a home, do you have, if you're considering buying a home, do you say, well, if you think you're going to move in 2 years, I wouldn't recommend it? Or is there like a time period that you would suggest?
Yes, I tell clients you need to stay in 2 to 3 years. Of course, I was still saying that same thing in 19 and 20, and people were moving like within a year. Now, of course, other things come with that, capital gains tax, things like that. But, that's for a whole different podcast. But yeah, I would still say we're back to that, hey, this is a 2 to 3 year,
it's a long-term investment.
right. To where I think what happens is, especially first-time homebuyers, they get scared about a 30-year mortgage. The likelihood that you are going to stay in that first house that you buy for 30 years is pretty slim. Does it happen? Absolutely. And I think back in maybe our grandparents' days, that is what they did.
Yeah.
But I would tell you anymore, the average is 5 to 7 years that people stay in their house. And maybe that's gone up a little bit more to 7 to 10, but it used to be 5 to 7. I think I see people sitting in their houses a little bit longer, especially with interest rates.
Yeah, and I think that's a unique situation. We've talked about the golden handcuffs,
Correct.
right? And having that super low interest rate
Yes.
that is just keeping people in homes maybe they don't want to be in any longer.
Correct. As you had mentioned at the beginning of the podcast, right? Like, things change. We've talked about this before, family dynamics. You get married, you get divorced, you have a life happens, right?
Babies.
Children, marriages where you're blending families. I mean, people need bigger houses, smaller houses.
Parents' health need to come move in with you, ADUs, all kinds of different things happen.
Correct.
And so you really have no idea where life is going to take you over the next 7 years. And I know that people love the 30-year fixed. And it's a great product. But the 7-year fixed loan is one of my favorite loans because you can get a great upfront rate for those 7 years that does not change.
And you know what's funny was that those arms weren't really moving at the very beginning.
But I think we'll see them. I think we'll see rates come down lower. And so that's something that if you
Right.
want more information, give me a call. I think they have a little bit of a bad name. I think they're a great
We did an
product.
ARM when we first moved into our house when we were first-time home buyers. We did a 5-year ARM. I didn't think they had 7-year ARMs, but I know they do
3,
now.
5,
But
and
back-
7 are typically the
Right.
terms of the fixed period
right.
at the beginning.
And
of
back
the
in
loan.
those days, they didn't have that. We had a 5-year ARM.
Yeah.
And then we just refinanced out of it. And
Right.
yeah. And then went with a 30-year or a 5-year, what was ever in our favor. But I think what people need to know is like maybe sometimes you do need an ARM to get in because as you said, usually you push a little
that
bit.
That rate can be
Right.
a bit lower.
Right.
So if we can get you in a quarter, to
Right.
a half maybe.
And maybe you hold on with that loan for 3 to 5 years. And at that point in your career, as you
Grow into the home, grow into the payment.
grow into your whatever business you do, into your career, into your occupation, you usually end up making more and more money as you get right. And so you can grow into that payment. And
Absolutely.
so maybe you start with that at a lower payment and then you can refinance it if you need to.
Great.
Right.
Yeah. That's great information, Tim. Thank you.
I'm piggybacking off of you.
I appreciate it. No, you're absolutely right. And I think on that note, we should leave it there. I want to say congratulations once more. We made it. One more.
Oh, I thought you were going to say congratulations. I'm wearing a CU Buffs
Oh, yeah, that
sweatshirt.
too. I mean, funny how I didn't have to mention it, but she did. So,
I
hey,
can feel it.
she's ready to get off. Maybe we keep the podcast going a little longer.
I think we're good.
All right. Hey, if you found this podcast useful or know somebody who might, please give us a like, share us. You can find us on iTunes, Spotify, and YouTube.
Yes. See you next week. Thanks.